Welcome to the deep dive. We cut through the noise to bring you the insights that really matter. Think of it as your fast track to getting up to speed.
Yeah, we do the digging so you get the core understanding, the takeaways you can actually use.
And today we've got a really specific focus. We're pulling actionable advice from a seasoned trader, lessons shared with a young, aspiring trader in the Indian market. Let's call her Miss Mansi.
But this isn't just for Miss Mansi. It's really for you if you're looking to understand the Indian stock market better.
Exactly. We're going to be looking at this veteran's experience through some major market events, all from an Indian perspective.
Uh-huh. We're talking the dot-com bubble, the 2008 crash, that sudden COVID drop, the Russia-Ukraine war impact, even the Trump-era volatility. It's quite a range.
So the goal here is to give you, like Miss Mansi, that practical know-how to navigate the Indian market and hopefully sidestep some common mistakes. Okay, let's jump in. First big pillar, mastering the fundamentals.
Right. This is absolutely foundational. You can't really build anything solid without understanding this stuff. It's about economics, sure, but also psychology and how events, both global and local to India, shape things.
Yeah, the veteran really stresses understanding the market's core nature first. It's not just numbers on the screen, is it? It's about people, emotions.
Precisely. Markets really reflect human behavior, that constant tug of war between, greed when things look good and fear when they turn sour. The dot-com bubble is a classic example.
Globally, yeah. How did that play out in India specifically?
Well, even solid Indian tech firms, think Infosys back then, got caught up in that global tech excitement and then faced pretty significant corrections that show that even strong sectors aren't immune to that kind of, valuation mania.
And then you have unavoidable global events like the Russia-Ukraine war more recently. That sent oil prices rocketing. How did that hit India?
Well, India imports a lot of oil, so higher Brent crude prices definitely put pressure on the economy. But it's interesting, right? Because for some Indian companies, like, say, ONGC in the oil and gas sector, those higher prices were actually a benefit.
So it's never quite straightforward.
Exactly. It shows how interconnected things are, but also how specific impacts can vary.
And that brings us to the India-specific context.
Mm-hmm.
The Indian market isn't just a mirror of global trends, is it?
Not at all. It's got its own drivers.
Ah.
Think about domestic policies like GST or initiatives like Make in India. Plus, the big sectors here, IT, banking, consumer goods, they have a huge influence on the Sensex and Nifty movements.
So for someone listening, trying to get a grip on this, what's a practical first step?
The advice is to really look at Indian market history. Use resources like Money Control or educational stuff like Zerodha's Varsity. Check the BSE and NSE data. See how past global shocks like 2008 or COVID specifically affected the Indian indices. That history gives you perspective.
Okay, fundamentals, pillar number 2. Getting the financial basics right. This feels like looking under the hood of individual companies.
That's exactly it. You have to understand if a company is financially healthy. The veteran really emphasizes the balance sheet here. It's like a financial snapshot. What a company owns, what it owes, and the equity at one specific moment.
And the 2008 crisis is a stark reminder of why that snapshot matters so much.
Absolutely. You look at Lehman Brothers collapsing under the weight of toxic debt on its balance sheet. Contrast that with, say, Indian banks like HDFC Bank. They were generally more resilient, partly because they had lower debt-to-equity ratios. Less than 1 is usually a good sign.
All right, less borrowing relative to their equity.
And strong cash reserves, too. That helps weather storms.
Okay, what about the income statement? What are we looking for there?
The income statement tells you about performance over time, revenues coming in, expenses going out, and the profit left over. You want to see consistent revenue growth, like you often see with big players like Reliance Industries.
And profits.
Yeah, watch the profit margins, too. Are they getting bigger or smaller? That tells you how efficient the company is.
And the third key statement, the cash flow statement. Why is that one so vital?
Cash flow is king, as they say. It tracks the actual cash moving in and out. The really important bit is free cash flow, or FCF. That's the cash left over after the company pays for everything it needs to keep operating and growing.
Like maintaining factories or equipment.
Exactly. Companies with strong FCF, like TCS, often demonstrates they have more flexibility, especially during downturns. They have the cash to survive, maybe even invest when others can't.
Okay, now for those metrics, PE ratio, EPS, debt to equity. It can feel a bit like jargon soup.
Mm-hmm.
How do we make sense of these in the Indian context?
Let's break them down. PE, price to earnings. Basically, how much are investors paying for each rupee the company earns? It's most useful when you compare it to other companies in the same sector.
Like comparing Infosys's PE to other Indian IT firms.
Precisely. Indian IT often trades in the 20-30 PE range. If you see a PE way higher than that, like some stocks during the dot-com boom, that could be a warning sign. Overvalued, maybe risky.
Got it. And EPS.
Earnings per share. Simple concept. Total profit divided by the number of shares out there. What you want to see is consistent growth in EPS over time. Think of a company like Bajaj Finance, often cited for its EPS growth. That signals growing profitability.
And debt to equity, we mentioned it with HTFC, but it's worth hammering home.
Definitely. High debt means the company relies heavily on borrowing. That's fine when times are good, but it gets risky in a slowdown. Some Indian real estate firms learned that the hard way in 2008. You generally prefer companies with low debt, like, say, HUL, more stable.
Are there any specific financial risks unique to India we should watch out for?
Yeah, a couple of things. Regulatory changes from the RBI, the Reserve Bank of India, can have big impacts, especially on banks and finance companies. And never underestimate the monsoon. It hugely affects agriculture, and that ripples through related sectors and consumer demand.
So for Miss Mancy, and for you listening, what's the actionable tip to start digging into these financials?
Use a tool like Screener.in. It's great for Indian companies. Start with names you know, Reliance, HDFC Bank, whatever. Look at their numbers. Then you can cross-reference with the official filings on the BSE or NSE websites for the real details.
All right. Fundamental pillar 3, economic awareness. Understanding the bigger picture. How do things like inflation or interest rates affect the market?
These macro factors are like the tide they lift or lower all boats to some extent. Think back to 2008. The global credit crunch definitely impacted India's banks, though, as we said, the RBI helped cushion the blow. Or 2022, the Russia-Ukraine war fueling inflation here, hitting around 7% CPI. That squeezed consumer spending in companies like Maruti.
Okay, let's talk specific indicators. Interest rate's always a big topic.
Right. When the RBI hikes rates like they did in 2022-23 to fight that inflation, borrowing gets more expensive. That can slow down growth for some companies. But funnily enough, banks like SBI can sometimes benefit because their lending margins might improve.
And inflation itself. You mentioned Maruti.
Yeah, high inflation eats into people's buying power. And for companies, especially in consumer goods like ITC, it can squeeze their profit margins if they can't pass on rising costs to consumers. So watching that CPI data is key.
GDP growth feels more straightforwardly positive.
Generally, yes. India aiming for that 6-7% growth range is a strong positive backdrop for the market long term. Compare that to the global slowdown in 2008. A growing economy usually means growing company profits.
And the RBI's role beyond just interest rates.
Oh, huge. Think about 2020. The liquidity measures the RBI took, pumping money into the system, were a major factor in the market's rebound after the COVID shock. Their policies really influenced the flow of money.
What about specifically Indian economic things to track?
Definitely the annual union budget that sets the government's economic direction, RBI policy announcements, obviously, even monsoon forecasts, as we mentioned, and big events like demonetization in 2016 or GST in 2017, they caused major short-term ripples.
So, for our listener wanting to stay on top of the Indian economy, what's the practical advice?
Keep an eye on RBI updates their website, major financial news outlets like Economic Times, Business Standard, and track how global shocks, like Ukraine, affect things crucial to India oil imports. The value of the rupee, it's all connected.
Okay, that covers the fundamentals, market nature, financials, economics. Let's move to pillar 2, something less tangible, but maybe just as critical. Building a resilient mindset.
Ah, yes, the psychology of it all. This is huge. The market will test you. Having the right mindset helps you avoid those emotional decisions that can really hurt your portfolio.
First point here, embrace volatility. Easier said than done when your portfolio is dropping.
Oh, absolutely. It's tough emotionally. But the veteran's point is volatility isn't weird, it's normal. Look at the Sensex, down over 50% in 2008, down almost 40% in the 2020 crash. But it recovered. Panicking and selling just locks in those losses.
Whereas holding quality stocks can pay off.
Exactly. Think of something like Asian Paints holding through that 2020 dip rewarded investors who stayed calm. The key is focusing on the quality of the business you own.
You had a personal example with pharma stocks during COVID.
Yeah, during that initial panic phase, I held onto positions in Indian pharma like Sun Pharma. They dipped with everything else initially, but, as the focus shifted to treatments and vaccines, they recovered strongly and then some. Short-term fear created a long-term opportunity, really.
What drives volatility specifically in India?
FII flows. Foreign institutional investors are a big factor. When they pull money out, like they did significantly in 2022 due to global reasons, it can shake the market. The key is not to panic when you see those headlines. It's often not about the Indian companies themselves.
So the actionable advice for handling volatility.
When the market tanks, ask yourself, has the fundamental reason I bought this company changed? If the core business is still sound, the veteran suggests, maybe you hold on. Or even, maybe you consider buying more if the price looks attractive.
Okay, next mindset muscle. Patience. Seems obvious, but hard in practice.
So hard. We want results now. But wealth building in stocks is usually a long game. It's about compounding your returns start earning their own returns. Think about the post-2008 recovery. It took the Sensex about 5 years to get back to its peak.
But good stocks kept growing underneath.
Exactly. Stocks like HDFC Bank just kept chugging along, rewarding those who held on.
Can you give us a hypothetical?
Sure. Imagine you invested, say, 1 lakh back in 2009 after the crisis. If you just let it ride in a decent mix of Indian stocks, by 2025, that could easily be 5 lakh or more. That's the power of time and compounding.
And your Infosys example fits here too.
Yeah, buying post.com crash around 300 split adjusted, holding through all the ups and downs since then, it generated, well, very significant returns by 2025. That doesn't happen overnight. It takes patience.
So the actionable tip for patience.
Think long term, like 5-10 years minimum. Try to ignore the daily nifty buzz. Focus on the underlying business growth.
Final mindset point. Avoid FOMO, the fear of missing out. This one feels dangerous.
It really is. FOMO makes you jump into things without thinking, usually after they've already shot up. Remember the trope tweets about trade wars? They'd cause wild swings, hitting Indian exporters like Tata Motors. Or think about those meme stock surges in India in 2021. Pure hype, then crash.
And you mentioned a specific Indian context here.
Yeah, the rise of retail trading platforms like Zerodha, while great for access, also fueled some of that frenzy in 2021, especially in small caps. People were chasing quick gains, driven by FOMO.
So how do we fight FOMO?
Be suspicious of stocks rocketing up without clear fundamental reasons. The veteran points to the Adani Group volatility in 2022. If a stock price seems totally disconnected from its earnings or prospects, just wait. Let the hype die down. Look for a rational entry point if one even appears.
Okay, fundamentals mastered, resilient mindset developing. Pillar 3, develop a robust strategy, getting down to the nitty-gritty of planning.
Exactly. You need a clear plan. What are your goals? How much risk can you handle? What's your time frame? Your strategy needs to fit you.
First step, define your goals. Are we talking short-term trading or long-term investing?
That's the core distinction. Short-term trading, maybe day trading reliance or SBI using charts. Technical analysis, that's one path. It's active, potentially higher risk. The veteran tried it back in the 90s, but found long-term investing suited him better.
And long-term investing is more buy and hold?
Right. Picking quality stocks like Titan or maybe a Nifty 50 ETF and holding for years, aiming to benefit from overall growth.
And you mentioned India's growth story favors the long-term approach.
Yeah, with steady GDP growth and a rising middle class, the long-term picture for many good Indian companies looks pretty solid. That really supports a patient long-term investment strategy.
So actionable advice for a beginner, defining goals.
Start with long-term investing if you're new. It's generally less stressful. You can always experiment with trading strategies later using a small part of your capital on platforms like Zerodha or Upstocks just to learn.
Goals defined. Next up, diversify wisely. Don't put all your eggs in one basket, right?
The classic advice, and it's classic for a reason, spread your money across different sectors, IT, banking, FMCG, etc. Maybe different asset classes too, stocks, bonds, gold, even different regions, maybe some global ETFs alongside your Indian ones.
How does diversification help during tough times?
Think 2008 again. Indian real estate stocks got hammered, but FMCG like HUL held up much better. Or the Russia-Ukraine war energy stocks did well, while IT maybe lagged. Diversification smooths out the ride.
Can you give some Indian examples for diversification?
Sure. You might mix PSU banks like SBI with consumer goods like Nestle India, and maybe an infrastructure play like L&T, spreading across different parts of the economy.
Actionable tip for diversifying.
Aim for maybe 10-20 different stocks or ETFs. A simple Nifty 50 ETF like Nippon India's gives you broad exposure right away. Or you could explore thematic baskets on platforms like Smallcase.
Okay, goals, diversification. Now risk management, protecting your capital.
Absolutely critical. This is about survival. 3 key parts: position sizing, stop losses, and cash reserves. Let's start with position sizing.
Did that work?
It's about deciding how much of your total money to put into a single stock or trade. The rule of thumb is don't risk more than, say, 1–2% of your whole portfolio on any one idea.
So if you have 5 lakh,
You wouldn't want to risk losing more than 5,000 to 10,000 on a single trade if it goes wrong. The veteran mentions this helped limit damage during the ILNFS default shock in 2018.
makes sense. What about stop losses?
That's your safety net. In order to automatically sell if a stock drops to a certain price you set, it limits your downside. Maybe set it 5–10% below where you bought in.
Any caveats?
Yeah, in really choppy markets, like for airlines like Indigo during COVID, a tight stop loss might get triggered by normal volatility, kicking you out too early, so you might need to adjust based on the stock and market conditions.
And the third part, cash reserves. Why keep cash on the side?
Opportunities. Market dips happen. Having cash ready, maybe 10–20% of your portfolio, lets you buy quality companies when they go on sale. The veteran gives the example of buying Bajaj Finance around 2000 during the 2020 dip that paid off handsomely.
Any India-specific risk thoughts here?
Liquidity in small caps can be lower sometimes. It might be harder to sell quickly without affecting the price. So, especially for beginners, focusing on larger, more liquid large-cap stocks offers a bit more safety.
Actionable tip for risk management.
Plan your exits before you even enter a trade. Know where you'll take profits, and definitely know where you'll cut your losses using that stop loss. There are formulas for position sizing, but the core idea is limit your risk on every single trade.
Final strategy point. Value over hype. Focus on substance, not sizzle.
Exactly. Look for companies with solid fundamentals, consistent revenue, low debt, maybe a strong brand or competitive advantage, like HUL's distribution network. The veteran avoided those hyped-up tech stocks in 2000 and bought TCS at reasonable prices instead. Focus on long-term value.
Is hype a particular issue in India?
During bull runs, you definitely see speculative money flow into small, often unprofitable companies. It's tempting to chase, but the advice is to stick with businesses that actually make money and have a solid track record.
Actionable tip for finding value.
Again, tools like Screener.in are great. Filter for stocks with reasonable PE ratios, say under 20, good return on equity, ROE, maybe over 15%, and low debt. Then compare those companies against their peers. Do your homework.
Okay, strategy covered. Pillar 4. Learn from history. Using past market events as lessons for today's Indian trader.
This is so important. History doesn't repeat exactly, but it often rhymes. Understanding past cycles and crises gives you context and helps avoid repeating old mistakes.
Let's start with the dot-com bubble, 1999–2002. What's the key lesson?
The big one. Valuation matters. Even good Indian IT firms like Infosys saw their stocks fall maybe 50% or more when that global tech bubble burst. Lesson. Avoid stocks with sky-high PE ratios unless the growth truly justifies it.
Any India-specific angle to the recovery?
Yeah, Indian IT recovered well, driven by the outsourcing boom. It showed that focusing on sector leaders with strong business models pays off, even after a crash.
Actionable tip from the dot-com era.
Check historical PE ratios. BSE archives can help. Be very wary of anything trading consistently above, say, 50 times earnings without phenomenal proven growth.
Next event, the 2008 financial crisis. Lessons learned.
The danger of too much debt, globally and locally. It hit Indian banks, and real estate hard DLF, for instance, fell massively. But RBI policies helped stabilize PSU banks. Lesson. Avoid highly leveraged companies and keep an eye on global risks.
How did India fare overall compared to, say, the U.S.?
India's market actually fell less, partly thanks to strong domestic consumption. It highlighted the resilience of sectors like FMCG here.
Actionable tip from 2008.
Screen for low debt. Use Money Control or Screener.in to look for companies with debt-to-equity below 0.5 as a starting point for safety.
Moving to the COVID crash in 2020. Key takeaways.
How quickly things can change. The Sensex dropped 38% fast, but the recovery was also swift, boosted by stimulus and strength in pharma, like Dr. Reddy's. Lesson. Crises create buying opportunities, but don't try to perfectly time the bottom. It's almost impossible.
Specific Indian sector performance.
Pharma and IT did well in the recovery. Travel, like Indigo, obviously struggled. It also showed how strategies like dollar cost averaging, or SIPs, worked really well for those who kept investing through the dip.
Actionable tip from the COVID experience.
Consider regular investing through SIPs, maybe $10,000 a month, into something like a nifty ETF, especially when the market takes a hit. It averages out your purchase price.
What about the Russia-Ukraine war starting in 2022?
Showed how geopolitics directly hits markets. Rising oil prices hurt India's import bill and the rupee, but energy stocks like ONGC benefited. Lesson. Geopolitical shocks shift money between sectors.
India's specific angles here.
Our reliance on imported oil makes energy stocks sensitive. Also, potentially defense stocks like HAL gain attention during global conflicts.
Actionable tip related to geopolitics.
Keep an eye on Brent crude prices, Bloomberg, etc. During high-tension, energy ETFs or related stocks might be worth researching.
Lastly, the Trump volatility.
Yeah.
2016-2020. Lessons from that.
Trade war talk, often via tweets, created short-term noise, hitting exporters like Tata Steel. But the market eventually stabilized. Lesson: try to ignore the short-term noise and focus on India's underlying growth story.
How did it affect different Indian companies?
Exporters were more vulnerable. Domestically focused firms like Bajaj Finance were less directly impacted. It also highlighted how FII flows react to global uncertainty, adding to Indian market volatility.
Actionable tip from the Trump era.
You can use platforms like X to gauge sentiment, sure, but don't trade based on tweets. Prioritize company fundamentals over political noise.
Okay, powerful lessons from history. Pillar 5. Practical tools and habits for effective trading. Getting equipped.
Right. This is about the day-to-day discipline and resources. First up, research relentlessly.
Where should Indian investors look for information?
Money Control, Screener.in, the official NMBC websites are essential for data, news, filings, and actually reading company annual reports is crucial. The veteran mentions this helped avoid shaky IT firms back in 2000.
Any potential issues with Indian company data?
Sometimes data might not be perfectly clear or consistent across sources, so always cross-check important figures with the official SEBI filings if you can. Be thorough.
Actionable tip for building a research habit.
Try spending just 30 minutes a day. Pick one company, read its latest earnings report, or listen to the management commentary from their conference call. Consistent small efforts add up.
Next habit. Track sentiment. How do we gauge the market mood?
Social media, like X, can give you a feel for retail sentiment. You saw panic there in 2020, maybe excessive hype in 2021. But don't trade based only on sentiment. Verify everything with actual data and fundamentals.
Specific Indian sentiment patterns to watch for.
There's often a lot of buzz about small caps among Indian retail traders on X. Treat that with extra caution. Don't get sucked into hype without doing your own homework.
Actionable tip for tracking sentiment.
Follow reputable sources, like at BC India on X, but always prioritize the financials and company specifics over online chatter.
Okay, another tool. Backtest your ideas. Testing strategies before risking real money.
Exactly. Use historical data to see how your strategy would have performed. Platforms like Zero to Streak or TradingView have tools for this. The veteran backtested a value strategy after 2008 to build confidence in it.
Any limitations for backtesting in India?
As mentioned, lower liquidity in some small caps might skew results. It's often better to start backtesting with large cap stocks first, like those in the Nifty 50, for more reliable data.
Actionable tip for getting started with backtesting.
Pick a simple strategy, like buy Nifty 50 stocks when PE is below 15 and run it on past data using a platform like TradingView. See what happens. It's a great learning exercise.
Final habit. Journal every trade. Why is record keeping so important?
It's how you learn from your own experience, your wins and your losses. Log your entry-exit points, why you made the trade, what happened, and what you learned. The veteran mentioned selling ICICI Bank too early in 2008 out of fear. Journaling helps identify those patterns.
Actionable tip for journaling.
Use a simple spreadsheet, Google Sheets, Excel, or a dedicated app like Traderizer. Record everything. Then, crucially, review it regularly, maybe once a month. Ask yourself, what worked, what didn't, why?
Excellent practical advice. Now, pillar 6. Avoid common pitfalls. Mistakes that new traders often make.
Yeah, knowing what not to do is just as important. 3 big ones: misusing leverage, chasing trends, and getting swayed by noise. First, leverage.
Why is leverage or margin trading so risky for newcomers?
It magnifies everything. Gains, yes, but losses too. You can lose more than your initial capital very quickly. The veteran saw leverage traders get wiped out in the 2008 real estate downturn here. He survived by sticking to cash.
Is high leverage readily available in India?
Yes, many brokers offer it, and it looks tempting. But the risk, especially when you're learning, is just too high for most people. The advice is clear. Avoid it.
Actionable tip regarding leverage.
Simple. Trade only with the money you actually have in your account. Use standard demat accounts from brokers like Zerodha. Don't borrow to trade.
Second pitfall. Don't chase trends, buying what's already hot.
Right. Jumping onto hyped small caps or IPOs after they've soared, like maybe Zomato in 2021 initially, These often correct sharply, leaving trend chasers holding the bag. It's usually driven by FOMO, not fundamentals.
Is this common in India?
Retail enthusiasm on platforms here definitely fuels some speculative rallies. You have to be aware of that herd mentality.
Actionable tip for avoiding trend chasing.
Be skeptical of stocks with extremely high PE ratios, maybe over 50, unless there's truly exceptional proven growth backing it up. Focus on sustainable value, not just momentum.
Final pitfall. Ignore the noise, getting distracted by headlines and hype.
Exactly. Media and social media amplify fear during crashes and greed during rallies. Think 2020 fear, 2021 hype, or those Trump tweets causing short-term swings. You need to filter it out and focus on the underlying data and your long-term plan.
Does the Indian media landscape contribute to noise?
Some TV channels, can sensationalize daily market moves. It's easy to get caught up. Sticking to fundamentals is your shield against that noise.
Actionable tip for ignoring noise.
Limit your news intake. Stick to reputable sources like Economic Times or Business Standard for actual information, not just commentary. Don't let headlines dictate your investment decisions.
Right, almost there. The seventh and final pillar. Lifelong learning. The market never stops evolving.
Absolutely essential. You can never know it all. The market changes, the economy changes, new industries emerge. You have to keep learning to stay sharp.
First suggestion. Read classics. Any specific books recommend?
The Intelligent Investor by Graham, The Bible of Value Investing. Really useful post-2008 for picking up solid Indian banks cheap. One Up on Wall Street by Peter Lynch. Great for finding ideas in companies you encounter daily, like maybe noticing Titan's growth. And Market Wizards by Schwager interviews with top traders showing diverse approaches you can adapt.
Actionable tip for reading.
Aim for one classic every few months. Start with Graham. Build that foundational knowledge.
Next, study greats. Learning from successful investors.
Yeah, learn from Buffett's focus on quality and fair price applicable to buying HUL, perhaps. Ray Dalio's emphasis on diversification is perfect for India's volatility. Maybe even Cathie Wood for insights into disruptive tech like Zomato, but always, with caution about valuation.
Any Indian investing legends to study?
Definitely. Study someone like the late Rakesh Jhunjhunwala for his deep understanding of the Indian context and long-term approach. Huge local insights there.
Actionable tip for studying greats.
Read Buffett's annual letters. They're packed with wisdom. Look for interviews or analysis of Jhunjhunwala's strategies and investments.
Finally, stay updated. What trends should Indian investors watch now?
Looking ahead to around 2025, themes like AI may be impacting Tata Elxsi, green energy, Adani Green, and others. Continued infrastructure spending benefiting L&T. And always watch the union budget and SEBI announcements.
Actionable tip for staying updated.
Follow SEBI for regulatory news. Keep an eye on reputable financial news handles on X, like at ET Markets, for current trends and analysis.
Okay, we've covered all 7 pillars. Now let's bring it all together with some personal advice for you, the listener, mirroring the guidance for Miss Mancy starting out.
Right, this is about putting it all into practice, those first crucial steps for anyone new to the Indian market.
First piece of advice, start small. How small?
Really small. An amount you are genuinely okay with losing. Maybe 10,000, maybe 50,000, whatever feels comfortable. And definitely practice first with paper trading on platforms like Zeroda's Kite to get the hang of it without risk.
Actionable first step here.
Open that demat and trading account. Then, make one small trade in a well-known stock like Infosys just to learn the process from start to finish.
Next advice, find a mentor or community. Why is connection important?
Learning from others' experiences, getting support, bouncing ideas around, it's incredibly valuable. Helps you avoid reinventing the wheel or making rookie mistakes. The veteran learned from peers back in the day.
Where can people connect in India?
Look at online communities. Check out X handles like @ZeroHo Online. Forums like ValuePick have serious discussions. Subreddits like India Investments can be helpful too. Just remember to always verify information you get online.
Third piece of personal advice, stay disciplined. Controlling emotions.
Crucial for new traders. Panic selling during the 2020 lows is a prime example of emotion taking over. You absolutely need to stick to your predefined plan, especially when the market gets scary or overly exciting.
Actionable step for discipline.
Write down your trading plan. Goals, risk limits, strategy, entry-exit rules, then review it regularly, maybe weekly. Keep yourself accountable to that plan.
And the final, very important piece of personal advice, be patient.
We've said it before, but it bears repeating. Compounding takes time. A 1 lakh investment growing at 10% a year takes time to really build momentum. Think about the veteran's long-term success with TCS that didn't happen in a year or two.
Final actionable tip on patience.
Consider starting SIPs, regular automated investments into Nifty 50 ETFs or solid stocks like HDFC Bank. Set it up, let it run, and focus on the long haul. Let time and consistency work for you.
Wow, that really was a deep dive. So much valuable insight packed in there for anyone looking at the Indian stock market.
It really is. The potential in the Indian market is significant, no doubt about it, but it absolutely demands discipline, knowledge, and that patient, long-term perspective we talked about.
We've covered so much learning from the dot-com crash, 2008, COVID, geopolitical events, Trump's tweets, all through that Indian lens. Plus the core advice. Master fundamentals, build the right mindset, have a strategy, use the right tools, avoid pitfalls, keep learning.
And that final advice for you, the listener starting out. Start small, find support, stay disciplined, and be patient. It really boils down to those key actions.
So as we wrap up, here's something for you to think about. Of everything we discussed today, the analysis techniques, the strategies, the historical lessons, what specific area sparks your interest the most? What do you feel compelled to dig into further for your own journey in the Indian market? Hopefully this deep dive has given you a strong starting point.